Let's discuss about fiscal and monetary policy, the two pillars of economic management. Fiscal and monetary policy are the cornerstones of managing a healthy economy. They work together, yes, but through different channels to achieve shared goals. Concept: monetary policy, decision made by central bank like Federal Reserve in the United States to influence the money supply, money supply and interest rates in an economy, yes, interest rate. And the fiscal policy is decision made by the government. It is difference lies between the organization, yes, made by government about how much to spend and how much revenue to collect through taxes. This is about money supply and interest rates, and this is about collecting revenue through taxes. Then shared objectives: your money supply and interest rates in an economy. And the shared objectives are promote a stable and sustainable increase in a country's output of goods and services. One is economic growth, another is price stability, and another is full employment. Price stability contains keep inflation, the rate of price increases under control to prevent economic distortions. And the instruments for monetary policy instruments. This for monetary policy means by central government, yes, central bank. Open markets of operations: buying and selling government bonds by the central bank to affect the money supply. And reserve requirements: the amount of reserve banks must hold on deposits with the central bank, influencing how much they can lend. And discount rate, interest rate the central bank charges banks for borrowing reserves, impacting lending rates offered to businesses and consumers. Whereas fiscal policy, by government collecting tax, okay, taxes. Spending, government spending instruments is government spending, taxation, and government borrowing. Spending means spending on infrastructure, social programs, and other areas. Whereas in taxation, lowering taxes put more economy in people's pocket, boosting consumption and investment. Conversely, raising taxes can cool down an overeating economy. And another is government borrowing. Borrowing to finance spending can provide a short term boost but comes with the burden of future debt repayment. Then, features. Features is speed. Monetary policy can be implemented quicker than fiscal policy, which often requires legislative approval. Precision. Fiscal policy can be targeted towards specific sectors of the economy, while monetary policy has a broader impact. And the coordination is ideally fiscal and monetary policy work together for maximum effectiveness. Speed is monetary 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 is greater than fiscal. And for the precision towards specific sector of economy, while has a broader impact, yes, monetary policy has a broader impact. It is in both case it is large. Monetary is greater than fiscal. and the coordination. And let's describe with fiscal and monetary policy in action. Examples with explanation. Scenarios. Recession blues. Imagine the country is facing a recession characterized by high unemployment and shrinking economy. Monetary policy response. The central bank lowers the discount rate. Yeah, the monetary policy because by bank. Bank. Then the central bank lowers the discount rate. Yeah, discount rate is, this can be one of the instrument. Yes, discount rate. The central bank conducts open market operations by buying government bonds. In case of recession, fiscal policy response, the government increase spending on infrastructure project. The government might implement tax cuts for businesses. Second scenario. For the same scenario, two kinds of responses are obtained. Inflationary woods. Now let's say, what does this mean? Let's see synonym. No synonym? Okay. Now let's say the economy is experiencing high inflation where prices are rising rapidly. Yeah, rapidly. If the price is rising rapidly, central bank raises the discount rate. Here it is also discount rate. Central bank conducts open market operation by selling government bonds. Always the same thing. Yes, decrease is spending on some programs could raise taxes. Yes, they are not mutually exclusive. They are means tied up. Yes, tied up. They often work in tandem to achieve economic goals. The effectiveness of each policy can be influenced by various factors, including severity of economic problem and the level of coordination between policymakers. There are trade-offs, means they should work in coordination. For instance, lowering taxes might boost growth but increase government debt. These are just few examples and the specific tools used by policymakers which vary depending on the economic situation. However, understanding the concept, objectives and instruments of fiscal and monetary policy can help you grasp how government and central banks work to keep the economy healthy and stable. Let's revise again, okay? Concept is monetary policy by bank, fiscal policy by government. Here, money supply and interest rate in an economy. Two things. Here, revenue to collect taxes. How much to spend and how much revenue to collect through the taxes. About taxes, yes, collection and spending. Whereas this is to supply, money supply and interest rate in an economy. Sheer objective is economic growth, price stability and employment. Instruments are open market operation, rate and reserve requirements. Fiscal policy, spending, government spending, taxation, government borrowing. Yes. Features, speed is high in both case. Monetary case also, precision also broad. Yes. Coordination is needed. Scenario is recession blues. Country is facing a recession. Then what does central bank lowers the discount rate? Central bank conducts open market operation. Fiscal policy, government increase spending on infrastructure project. Government fiscal policy, collecting taxes and spending the taxes. Very simple thing, yes. And this much. Thank you.